Hi there, I'm Jason Derbyshire for TradeLog Software. Today I want to help you to understand the IRS Wash Sale Rule. The Wash Sale Rule has been part of the U.S. tax code for almost 100 years. It's evolved over the decades and can be one of the most complicated of IRS regulations. The Wash Sale Rule is designed to prevent traders from harvesting losses through wash sales in order to evade capital gains taxes. IRS Publication 550 explains the wash sale rule, but it can be kind of complicated. So let me tell you some key points you need to know. First off, the IRS says that if you sell a loss and you replace it within a window that starts 30 days before the loss and extends to 30 days after the loss, then it's a wash sale. So if I sold, for example, shares of XYZ at a loss on November 21st, then a purchase of XYZ shares anytime between October 22nd and December 21st could be considered a replacement and trigger this as a wash sale. The IRS also covers more than just simple stock trades. It applies to stock or securities, which includes your options trades. However, the wash sale rule does not apply for Section 1256 contracts. These are typically your futures trades as well as some broad-based index options. And replacement isn't just buying, but the IRS says acquiring a fully taxable trade, so it can apply to other situations as well. The rule applies to all the accounts you control, and it also doesn't matter how many brokers you use. If you sell a security at a loss in one account, and then you replace it in a different brokerage account within the 61-day wash sale window, then it's a wash sale. In fact, the IRS says if the replacement is made by an account controlled by your spouse or a corporation that you control, it could also be a wash sale. And if you think you can replace a position in your non-taxable IRA account, the IRS says that's a wash sale too. And later I'll tell you why that's a really bad situation. So what happens if you have a wash sale? The IRS says that the loss is disallowed at that time. Instead, the cost basis of the replacement position is adjusted to include the amount of the loss. In the example I'm going to show you, you'll see I sold 100 shares of XYZ and had a loss of $100. When I replaced these shares a few days later, my actual cost basis for the replacement was $850, but I now adjust that by $100. That's the loss amount that was disallowed. My new cost basis for the replacement is $950. So you see, the loss isn't gone forever. I just can't take it until I close out the replacement position. Now here's the thing. These adjustments can accumulate if you continue to buy and sell the same security. Say that in our example, you turn around and sell the replacement position of XYZ at a loss, and then you make another replacement within the 61-day wash sale window. The loss is again disallowed and adjusted to the cost basis of the replacement. So it can snowball over time. In this example, also, if I open a call option on the same stock within the loss window, that option will also trigger a wash sale. Of course, most traders don't buy and sell the same number of shares all the time, so the IRS says the wash sale rule applies proportionally if the replacement is either more or less shares than the loss. So for example, if I sold 100 shares at a loss, and within the 61-day window, I bought 25 shares on one day and another 75 a different day, the loss amount is adjusted proportionally to the cost basis of these replacement positions. Now, if you close a short sale at a loss, the IRS specifically says that opening a new short sale on the same security during the 61-day wash sale window will trigger a wash sale. In addition, many tax experts say that the rules imply that buying the same security could trigger a wash sale on a short sale loss as well. You should also know that the rules require your holding period for a replacement position to include the holding period for the security that was sold at a loss. This prevents someone from converting a long-term loss into a short-term. Say, for example, I sold 100 shares that I held for a period of 400 days. The sale resulted in a loss. I replaced it within the 61-day window. The new shares I bought need to be adjusted to include the 400-day holding period. You'll see in this example, TradeLog software adjusts the date acquired on those replacement shares to include the 400-day holding period. Oh yeah, remember I said that replacing a position in your IRA can trigger a wash sale? When that happens, it's a really bad situation. The IRS says the loss is disallowed. However, there is no adjustment made to the cost basis of the replacement position in your IRA. So in other words, the loss is permanently disallowed, and this is really bad. Now you can learn more about wash sales by going to our website at TradeLogSoftware.com. Go to Resources, then click on IRS Wash Sale Rule. Our comprehensive guide provides more details, including a chart of wash sale triggers. Right now you might be worrying about how can I avoid wash sales, but before you get too concerned, check out my next video. In that video I'm going to explain how wash sales affect active traders and why you don't need to worry too much about them. So check it out. If you haven't yet subscribed to our YouTube channel, do that so you can stay up to date. And go ahead and check out our website at TradeLogSoftware.com where you can read more about the IRS Wash Sale Rule. Thanks again for watching. See you next time.